All right, thanks, Desiree. You know, in the current economic climate, the standard financial rules are changing, and that includes the way you should be saving for your retirement. So here to walk us through that whole economic maze, please welcome Anthony Truino. He's from the Barnum Financial Group. Now, Anthony, we've been talking a little bit off camera here. You were talking about this whole new financial paradigm. Things are changing. What do you mean by that?
They are. First of all, what you have to think about is you've heard a lot of in the media, it's not your mother's retirement, it's not your father's retirement. And it's very true. 20, 30 years ago, people used to have pensions. They had Social Securities. They put $2,000 a year into an IRA. They lived within their means. Voila, they had a great retirement plan. Today, we don't have, with pension plans going away, there's a more dependency on us as consumers to fund our own retirements, be self-sufficient. So there is a major shift, and the shift is we're going to have to learn how to create income streams that allow us to basically face longevity risk, get through it, inflation, sequence of returns, which is another risk. So it's very important that we're educated and understand that it's not the same as it was.
You know, a lot of folks, like to at least try to make light of the situation. My 401k is now a 201k. How do you design a strategy? It has to be very individualized for your clients.
It is, and it's very much customized specifically to the clients. So what we like to do is sit down with our clients and assess what they really require. And we talked a little bit off camera. It was very important when you say to someone, how much do you think you really need? And that's going to go back to what they spend on an annual basis. So cash flow is very important. Then I think you need to look at savings rates and their nest egg. And then what you have to do is at that point establish an end result, a goal, work backwards and say, listen, Sarah, you require 5, 6, 7, whatever percent rate of return. Right now, you're invested to make, 8 or 9% return, so you have a much higher risk. So if you would like to reduce your risk to hit that goal, you can do that given all your other variables constant. And that's a great strategy because I don't think a lot of people understand that they may be taking on more risk than they need.
Well, with market conditions the way that they've been, there have been a lot of folks who say maybe this is the time because of budgets being a little bit tighter. Maybe I should scale back a little bit. What is your advice to them?
Scale back? Well, I think what you have to look at is now is probably the best time to continue to invest your dollars given on the low point of the market of where we are. But it still boils back to smart risk. If you take smart risk, you're going to get good returns. If you look at historic of great money managers, what they've done, they take on smart risk. Warren Buffett may be the best investor out there. What does he do? He takes on smart risk. His motto is buy what you know. And that's what he does. So taking on smart risk, I think, is the best point right now. I think that's what we can do.
Which is why I'm sure you would say that it's much better to ask a professional than to do it on your own.
I think you have to, and I think the game has changed so much. I have this conversation with my father all the time. My very first client ever in the business, her parents bought her 100 shares of General Electric back in the late 60s. When she walked in my door 10 years ago, she had somewhere around $250,000 worth of GE stock at the height of the market. Today, if she still had that, it'd be, a third of that, considering where it is. So I think it's very important that we realize that, you cannot do it the way you used to. You can't just buy and hold these major companies. There's a lot of opportunities. There's a global economy. Let the professionals help you do it. Doesn't mean you can't get involved. Doesn't mean you can't educate yourself. I would focus my time on how to pick a professional, not how to pick a stock.
And if you're nearing retirement, a couple quick tips?
If you're nearing retirement, give yourself a stress test. Okay? See what your assets look like. See what your savings rate looks like. You have to do a cash flow analysis. You need to understand what you spend. I have this conversation all the time with clients. There's no reason. Why would you retire to have a lesser lifestyle? You want to maintain the same. If not better, you work your whole life to do that. So you need to stress test yourself. You need to take a look at your expenses. You need to do a gut check on your portfolio.
So you can get there. You can enjoy retirement if you plan wisely.
I think you can. And it's also, at this point, with what's happened over the last year, I think if you're willing to be flexible, whether it's maybe work that extra year, save that extra dollar, maybe cut your expenses slightly, I think you can get there as long as anything in moderation.
All right, Anthony, thanks so much.